Hello, everyone. This is Kevin Miller. The video today is going to go over the first half of 2022, what has transpired with both the bond and stock markets. And then we're going to look at what we think may take place the last half of 2022, and then also identify how the evaluator mutual funds have held up so far this year. So the agenda is going to include a quick look at year-to-date bond and stock indexes, look at the Federal Reserve and how they're handling inflation, look at our economic indicators, talk specifically about bond market performance, the stock market performance, the last half of 2022, and then how the evaluator funds are performing. Our anticipation is that we don't think we've hit the bottom of the stock market sell-off, even though since June 30th, we've actually seen the stock market do somewhat relatively well. We still think that there's some concerns in the housing industry, which I'll get into in a little bit, that may give us a better point to buy in at a lower spot. So if we look at the most common bond index out there called the U.S. Aggregate Bond Index, you can see year to date, it's down 11.46%. Over last year, it's negative 12.25. This is all ending June 30th. Its 3-year return is negative 3% per year, and its 5-year return is negative 1.6% per year. And this is considered to be one of the most frequently used indexes for measuring the performance of the U.S. bond market. Another common index that we use for stocks is the S&P 500. And you can see that year to date, it's down 20%. Total return for 1 year, 11.92 minus. And then it does have a positive 3-year and a 5-year return. It's very uncommon to see the bond index be lower than the stock market index over any longer period of time. In this case, over a 1-year period of time, the bond index is minus 12 compared to minus 11.92 for the stock. And then also you can see the 3 and 5-year are substantially lower. They're negative when the stock market is positive. The first 6 months was historical for the bond market, according to Deutsche Bank. They went back and they researched when was the last time we had a first half in the bond market that was what we just experienced. And you'd have to go back to 1788 to find another period where the first half of the year bonds performed as poorly as they did this year. Okay. For point of reference, the president that was voted in on December 15th of 1788 was George Washington. That's just how uncommon this experience has been for bond fund investors. Now let's talk about the Federal Reserve and the inflation. The line here shows you what the Federal Reserve has done with their interest rate, and it's called the Federal Reserve funds rate. And what they do with that rate is that's what they charge banks to get money, so then the bank can use that money to borrow it to consumers and corporations. So you can see back in 01, 02, and 03, when the stock market had peaked and things were coming, stock market was starting to come down, they had lowered their rate very fast to try to help stimulate more economic activity. And then they slowly raised it as we went through the recovery. And then in 08, 09, when the stock market crashed, you can see how fast they dropped their rate down to 0. And then they started raising in 2015 and continued doing that through 2016 and 18 and even a little bit in 19. And then they peaked. And then when COVID hit 2020 and crashed the stock market, they dropped it like crazy again. And now we're seeing the stock market, as I just showed you, year to date is down over 20%, but they're doing the opposite. They're raising interest rates. In fact, the blue diamonds here indicate where they think their Federal Reserve funds rate will end up by the end of each year. By the end of this year, they expect it to be at 3.4%. By the end of next year, they expect it to peak around 3.8 and then to start coming down. Another vehicle we use for tracking what the Federal Reserve expects with their rate that they're charging banks. There are 18 board members that vote on a periodic basis, And you can see that for 2022, they pretty much, most of them all fall between 3.25 to 3.75. So that's, that's kind of what their target is right now, is in that mid 3.5% range. Next year, they anticipate, most of them expect the rate to go up to 3.75, but some of them could see it going up to 4.25. And then after that, it starts coming down. So we're kind of thinking that 4% number is probably the highest that the Federal Reserve will get the rate. And they can't push that rate too high because the amount of debt we have as a country is 130% of our GDP. It's $30 trillion, right around there. And so at 4%, if we're paying interest on $30 trillion, that's $1.2 trillion in interest. That'll be the second highest line item in our discretionary spending, next to our military budget. And that's just to pay interest. That's not even to pay off our debt. So if we track inflation, which we do on a monthly basis, you can see that back in June of 2021, inflation was 5.4% year over year. If you subtract from inflation what the Federal Reserve fund rate was, and their target back then was 0.25, 5.4 minus 0.25, the difference was 5.15%. That's what we call the spread. That was substantial. And when we saw this happening, this is what was telling us that this inflation was not transitory. This was going to be here, and it's going to get worse. And you can see that every month inflation kept going up, and until June of this year, it was at 9.1%. When's the last time this spread was this high? 1975, the spread was at 4.96. Inflation was 11.2%, and the Federal Reserve rate was 6.24. And then in 1980, the spread was 4.93, when inflation was at 14.4, and the rate was at 9.47. So what we do is we go back, we look, and we say, okay, what did the Federal Reserve do back then? And how did they address inflation? How quickly did they raise? So we could anticipate that with our asset management. But the difference is, back in the 70s and 80s, our country's debt was only about 30%, approximately about 30% of our GDP. Or like I said before, today it's 130% of our GDP. So we're carrying a lot more debt, which does put some handcuffs on what the Fed can do. This is a chart we put together that shows that spread. In March of this year, the spread was 8.3%. Inflation was at 8.5%, and the Federal Reserve funds rate was at 0.2. So if you see the blue circles here, the blue circles indicate that 1975 and 1980 period. And you look at this 1980 period, you can see how it peaked and then it just come down really fast. So if there's a gold mountain above the horizontal line, that means inflation is greater than the funds rate. If there's a gold mountain or inverted mountain below the horizontal line, then that means the Federal Reserve rate is higher than inflation. So you can see back in 1980, where it got over 4%, they immediately raised the Federal Reserve funds rate substantially and just slammed inflation, dropped it right away. We're sitting out over here where the red circle is. We've never had a spread this high. The Fed is going to try to slow demand because we just have too much demand for how much supply is out there. So they're going to try slowing demand by making things expensive. And the problem is they do have a ceiling on how high they can go with their interest rate because of how much debt we carry as a country. Let's look at economic indicators. PPI stands for Producer Price Index. That's what producers have to pay, the increase in costs that they incur just to produce their products. And in June, it was year over year, it was up 11.3%, which was near the record high of 11.8, and it was well above the 10.8 that was expected. We also can look at CPI, Consumer Price Index. In June, it was up 9.1%. I already indicated that. It was expected to be up 8.8, but this at that point in time was a 41-year high. So we know things are going up in price. What's driving it? Primarily, it's driving is price of energy. You know, if you look at transportation costs for goods, whether it's by truck, by air, by rail, or by water, everything is from a cost for transportation is as high as it's ever been. Another thing that's slowing down, could potentially slow down the economy, is the consumer sentiment. And you can see that that's the blue line here, and it, as of June, was at 50. Well, since 1978, it's never been recorded at 50. Back here in the recession of the 1980s, it looks like it's right around 51, 52. Typically, you can see it goes down before a recession or in a recession, and the recession would be any of these gray bars. So this is kind of concerning. This is why we've been defensive with our equity allocation since the early part of 2021, is because of the anticipation that this was what we're experiencing is what was going to transpire. Another thing to look at is employment. So we look at initial unemployment claims. How many people are claiming for unemployment for the first time? You can see that kind of bottomed out here in March, April, and May of this year, and now it's starting to increase. So then we look at how many people are maintaining their unemployment status, continued unemployment claims. And you can see that kind of bottomed out here in May to June area. It's kind of starting to pick up again. We look at participation rate. Are people going back to work? And you can see that our participation rate kind of peaked back here in March area. It's kind of going down. And then are we hiring more, or do we have more layoffs and discharges? Well, layoffs and discharges year over year just crossed over to being a positive relative to hiring just in May of this year. So our employment isn't looking really robust right now. Another thing, and this is the thing that we have our eye on the most, is housing. If the housing market slows down, then it will impact our economy. The good news is it gives us great opportunities to buy in at a very low rate. So we're not, these are all, in our opinion, for new money coming into the market, these are all very positive elements. Okay. New permits are slowing. We peaked and it looks like we're coming down. So, you know, when you buy a house, build a house, you have to file for permits, and those basically are slowing down. And then if you look at new housing starts have come down. And then new home sales are starting to decline. You're not getting the bidding process when people put their house on the market. In fact, we've been hearing that people have started to lower the price of their house because they're just not attracting enough buyers out there right now. One of the main things that's driving the housing market is the 30-year mortgage rate. A year ago, that rate was at 2.78%. As of this was July 21st, that rate was, on national average, was 5.54. So that rate has almost doubled within a 12-month period of time. And what impact does that have on the price of a house? Well, let's say someone has a rental payment of $1,750 a month, and their 30-year fixed rate, the 30-year mortgage, was 2.78 a year ago. They could have looked for a house that was in the $400,000 range, $400,000 to $430,000. They could have bought that house and maintained the same payment that they were paying for rent. But as soon as that mortgage rate jumped up to 5.54, then what they could afford went from 428 down to just over 300,000. That mortgage rate cost them $100,000 approximately in affordability with regard to what kind of house they could buy. Or it imposed a 28% decline on what they could afford. The solution would be the buyer would have to purchase a smaller home, the seller may have to lower their price, or they could get together and negotiate where the buyer pays a little more than what's budgeted, but the seller is willing to come down in price a little bit too. But that 30-year mortgage rate is an important factor in what's happening in our housing industry. One way to determine whether we're going into a recession or might be in a recession is you look at the difference between the yield on a 10-year treasury minus that of a 2-year treasury. So where the blue line is above the black horizontal line, that says that the 10-year treasury yield is higher than the 2-year. But when that blue line drops below the horizontal line, then you would actually earn more yield on a 2-year than a 10-year. That's inverted, okay? Well, you can see the gray bars represent a recession going back to 1980. And prior to every recession, that 2-year yield has gotten higher than the 10-year because this line has inverted. You can see it did it here in the late 70s and the early 80s, the late 80s, early 2000s, prior to the 2008 sell-off. And if we zoom that in, this is the exact same thing. It just looks at the most recent 12 months. And you can see that we inverted just slightly in April of this year, but then now we're at 0.41% inverted, meaning that the 2-year is outperforming the 10-year by 0.41%. On August 10th, I took this screenshot of CNBC website, and it showed the 2-year is at 3.2, let's just call it 3%, and the 10-year is at let's just call it 2.8%. So that spread is not dwindling. Probably the most important or surprising thing was that the 1-year is at 3.27, let's just round it, compared to the 30-year at 3.03. So you can get a higher yield on a 1-year instrument than you can on a 30-year. That's inverted, that's not common, and that typically indicates a recession is not far away. Now, if you watch the news at all, you'll hear that technically we are in a recession, and technically the definition of a recession has always been when you have back-to-back quarters of negative GDP, you are in a recession. So some of the elements are indicating that so, and then when this definition comes to fruition, you know, I guess it's hard to argue that we're just going to throw that definition out since it's been being used since we started tracking this, that it's hard to argue that we're not going to be in a recession if we're not in one already. So let's look at the bond market. As we indicated to you already, you know, it's had the worst 6 months, first half of a year since 1788. But before we do that and look at it in detail, I don't think a lot of people understand how you can lose money in bonds. I think people think I'll put money in bonds and I'm guaranteed a rate of return, and I'm not going to lose money. I'll explain here in 2 seconds how you can lose money in a bond market. But first, let's talk about what a bond is. It's issued by an entity, whether it's a government or corporation, when that entity wants to raise money for spending needs. So a hypothetical example is the U.S. government issues a 10-year treasury bond for $10,000. So you'd pay $10,000 to buy that bond, and they would pay 3% interest rate each year for 10 years. So an investor would pay $10,000 for the bond, receives $300 per year for 10 years. Then at the end of the 10 years, they get their $10,000 back. Sounds like pretty much a guaranteed situation, right? Well, when interest rates go up, bond values go down. So let's say back in December 30th of 2021, the 10-year yield on the 10-year treasury was 1.51%. That's what it was. This is realistic. And then not even 6 months later, on June 13th of 2022, that yield had gone up to 3.48%. It had doubled. What does that do to the value of your bond. Well, let's say investor A on December 30th decides to buy a US Treasury 10-year yield, a 10-year Treasury yielding 1.51%. So they'll get paid $151 for the next 10 years, and then they'll get their $10,000 back. Investor B on June 13th says, you know what, I'd like to buy a bond. They have two options. Option one is they could just purchase a new Treasury bond. The price is 10 grand. Interest rate, as we showed you before, is 3.48. So over the next 10 years, they'd get $348 a year in interest, and then they'd get their money back after 10 years. Or option two, they could purchase investor A's bond, but what would the purchase price be? Well, investor A would need to sell their bond at a price where the $151 of interest they're earning would equal 3.48% to investor B, because that's what they could get on the open market. So investor A would have to sell their bond for $4,339, because that amount times 3.48%, which is the current rate at that time, equals 151, which is what that investor A's bond is generating for annual income. So if they sold it at $4,339, but they bought it at 10 grand, they would have lost $5,000 in holding that bond for that 6-month period of time. So what happens is people buy bonds, and then they need money or whatever, they sell them. And if they have to sell them when interest rates are higher than the bond rate, the rate is on the bond that they own, they're going to have to sell them at a discount or at a loss. That's how you lose money. When interest rates go up, bond values will go down. But it works the other way as well. In December 30th of 2019, the yield on a 10-year Treasury is 1.92, and no more than 3 months later, it had gone down to 0.5. So let's look at this scenario. If investor A bought on December 30th a bond for $10,000 with an interest rate of 1.92 for 10 years, they'd get paid $192 a year for 10 years. In March 8th, investor B says, hey, you know what, I'd like to buy a bond, and I've got $10,000. I could buy a bond at that time that's going to pay me 0.5% a year for 10 years or $50. Or investor B could say, you know what, I'd like a higher yield than 0.5%. I think I'll give investor A a call and see what they would sell their bond for, because their bond is paying 1.92%. In that scenario, investor A would sell their bond to investor B at a price where 0.5% equals $192 a year of income. So investor A would sell their bond for $38,400, because $38,400 times 0.5% equals $192. So if investor A sold the bond at $38,400, they paid 10 grand for it, they would have made $28,400 and sold it at what we call a premium. Now, there are other elements that go into the pricing of a bond. It's the quality of the organization that's issuing the bond. It's the duration, how many years are left on that bond. So, but this is just a very quick overview, as quick as I can do it anyway, with how interest rates, when interest rates go up, bond values go down. When interest rates go down, bond values go up. So this is what has happened so far this year with the 10-year Treasury, which is a very common instrument that we use for monitoring how bonds are performing. Interest rates went up through April into May, then they went down for about a month. So bonds did all right in May. Then they went up the last part of the first half of the year. So we had, out of the 6 months, first 6 months of this year, we've had 5 months that were quite poor for bonds, and we had 1 month that was kind of mixed. It was decent. Now let's look at stock market performance. As indicated before, the S&P 500 is down 20% year to date, which is considered a bear market, meaning whenever the stock market's 20% lower than it was its most recent peak, that's indicating that it's in the midst of a sell-off. It's in a bear market. You can see here, this is the S&P 500 for the last 5 years. And people are looking at their statements and they're saying, hey, I need some money, but I don't want to sell at a loss. What should I do? Well, if you look at the red area, you would not, the deposits that were made in the red area, so pretty much through 21 and the first part of 22, all of those deposits, if you made any deposits or purchases in the S&P 500 at that time, you would have a loss if you were to sold it on August 10th, right? But you've got all this green shaded area where any deposit made over the last 5 years, and even just a few months ago, would have shown a gain. So if someone needed money, what you would do as an advisor is you'd sell some of the shares that have gains, and to offset capital gains, assuming it's a non-qualified account, you might sell a few shares that had losses. So the vast majority of their distribution would be from shares that generated gains, and you'd use just a few shares that have some losses to offset those gains. So from a taxable event, you wash out those taxes. So don't just look at the statement and say, oh my gosh, my account's down, I'm quote unquote losing money. You have a lot of deposits that probably have gains that you could easily sell just those shares, even though the market's down, and still walk away with gains on your investments. So it's very easy to do. Year-to-date performance of the S&P 500, we started up here. Into March, we went down the first few months. March, we went up. April, we went down. May, we went up. And then June, we went down. So kind of we were down more months than we were up. And unfortunately, if you look at the angle of these arrows, the angle down was much more steeper than the angle up, and for much longer duration. So if we look at the first half of 2000, or last half of 2022, we think the Federal Reserve continue to play catch up with inflation. We expect their 2.75% current federal funds rate to get up to around 3.5 to 3.75 by the end of the year. It may settle into 2023 in that 4 to 4.5% range. We see inflation continue, and we see it continuing to be sustainable. And it'll probably stay in that near 9%, in the 8% range for a few months. It'll begin to taper when payroll costs begin to decline. And the economy is going to continue to grind. It's going to feel a lot like it felt in 2012 through like 2016 in that time frame. Unless we see something substantial happen in a favorable manner with mortgage rates, we think the housing market's going to continue to slow due to rising rates, somewhat labor shortage, being able to find people that are willing to do that type of work. We do think that lower commodity prices will come out as a result of that due to lack of demand, and that could help lessen the slowdown in the housing industry. We think bond yields will stabilize once the Federal Reserve has reached its peak in their federal funds rate, which may not happen until mid part of 2023, something in that time frame. The stock market and bond market collectively are going to continue to be choppy, influenced by the Federal Reserve's decisions. We've got an election coming up in November. And then we have the geopolitical influencers. Primarily right now, our focus is on China and Taiwan, what could possibly happen there. Our game plan, our strategy is to not get overexcited about getting back into the market at this time. We feel that we're going to get another opportunity in September, October to get back in. We're looking at deploying more assets into equities in mid to late October. This is all just based on what we're viewing today. Because with the midterm elections coming up, we anticipate that one party isn't going to control all three components, the White House, the Senate, and the House, and that split control will probably be viewed as a positive from the stock market's perspective. And so I think we could see a little run up toward the end of the year. I'm not sure how sustainable it'll be based on consumer demand. I don't know if it's going to be a real strong Christmas because we're all paying so much more for food and gas that may be cutting into some of our savings. So if we look at how the evaluator funds are performing, you can see very conservative, moderate growth, and aggressive growth. And then you can see the bond index here and the S&P 500. The 0 to 15%, that tells you that the very conservative will never have more than 15% in stocks, could have as little as 0. So this is the stock range. The conservative will always have at least 15%, never more than 30. The conservative moderate will always have at least 30, never more than 50% in stocks, so on and so forth. Well, the current equity allocation is about 25% of this range. So we're at the lower end of our equity allocation range across all these investments, which means we have a higher fixed income or bond allocation range right now. We anticipate, like I said before, toward the end of October, to be increasing our equity allocation range to about half of what each fund's range is. So evaluator moderate, it has a minimum of 50, maximum of 70% dedicated to stocks. If we wanted to go halfway in that range, we'd lift equity allocation in that fund from 55% up to 60%. You can see what's happened with regard to year-to-date returns. Our heavy bond-oriented investment, which has 96% in bonds, it's down 7% for the year. Compare that to the bond index, which is down 11%. When things are not good, we want to prevent ourselves from participating in down markets as much as possible. You go to the other end of the spectrum, aggressive growth, which has 88% in stocks, that year to date is down 18%, which compared to the S&P 500 is down 20. So across the board, our investments relative to how things have transpired the first half of this year, even though we're down, we're relatively comfortable with where we're at compared to the indexes. Another way to measure risk management is to look at standard deviation. If the standard deviation number is big, you have the potential for higher highs and lower lows. So in a period of down, in a down market, whether it's stock market or bond market, you want this number small, because if that number is smaller, then that means you're going to have less of a loss than what is commonly found. So again, if you look at the one end of the spectrum, the very conservative, which has 96% in bonds, the standard deviation over the last year, which has been most volatile part of this investment cycle, standard deviation is 331 compared to all bond portfolio, which is at 5. So our volatility has been, about 40% less. If you look at the other end of the spectrum with aggressive growth, which has 88% in stocks, and compare that to 100% stock index, our 1 year is at 14% compared to 17. So again, we're probably 10-20% less volatility than what's happening in the stock market. You can see our volatility picks up as our stock market exposure picks up with each fund. But all that's said and done, we're not happy about posting a loss. We feel we've done relatively well with how the markets have performed, and with what is available, there's really no place to garner a positive return unless you just had your money sitting in cash. And we do have some of that. Some of these funds are holding cash positions. This is just a disclaimer that explains, again, the Bloomberg Aggregate Index, the S&P 500, what standard deviation is. Just make sure before you invest, you read the prospectus, and make sure you understand the the investment objectives and risks, so you make a good decision. Thank you, appreciate it. And we'll try to get another one of these out by the end of October. We just feel September, October could be some more volatile months and could give us some opportunity to deploy more cash into the stock market. Thank you.